Welcome everyone to our annual shareholders meeting. Quite a unique circumstances under which we're doing it this year. We hope that the communication is as it normally will be. So I'm going to start off with just an update as to our portfolio, and then we're going to take some questions. So in our updated shareholders published on the 28th of May, which was followed up by a shareholders letter, which was published only 3 weeks ago, we shared with you comprehensively the developments in our various investee companies and our portfolio over the past financial year, as well as events subsequent to year end. So the following comments are aimed at providing you with an update of the various businesses and our portfolio as of today. REC finds itself in a strong position. All our underlying businesses have managed successfully throughout the COVID lockdown. During this time, the only requirement for additional capital from REC was for growth opportunities, not to support existing operations. As those of you that are involved in business would know, this is no mean feat. This outcome is entirely a result of the strong, decisive leadership of the various management teams. Even though the COVID pandemic is not over and society's fearful reaction to the virus remains unpredictable, the various businesses have already settled into managing the operations according to the current circumstances, not a hoped-for future. The difficult decisions have been taken and implemented. More than 90% of our underlying investments are now unlisted, and we have not revalued these investments. It's therefore pointless to calculate an updated NAV per share at this time. We will give an accurate valuation with our interim results in November. It's only a couple of months away. Transactions subsequent to financial year end, REC sold its entire shareholding in Conduit Capital and invested a further 9 million rand into the Vehicle Care Group to expand its operations. So dealing with each one of our businesses individually, Gold Rush, which represents 66% of our assets. With the gradual easing of lockdown regulations, Gold Rush has been able to resume operations as from 1 July 2020. All bingo properties were open during the month of July and currently are operating at 50% of the capacity, i.e. only half the machines are switched on, every second machine. And that is per regulations. Just over 1,100 of the 2,200 limited payout machines were switched on during July, as many of the bars and taverns where these machines are hosted remain closed due to lockdown regulations. All retail sports betting shops were opened, while online gaming operations remained active. Gold Rush achieved revenue in July equal to 50% of the revenue achieved in July 2019. Recently announced further relaxation of lockdown restrictions will see an accelerated activation of the limited payout machines. Outdoor Investment Holdings, which represent 6% of our assets, experienced strong seasonal sales since it resumed trading early May 2020. The Family Pet Centre continues to grow sales at a steady pace as the business model is proving to be popular in the marketplace. JB Private Equity, which is also 6% of our assets, the only underlying asset here is the shareholding in Unicorn Capital Partners, which is subject to an all-share takeover offer by Afrimat at a ratio of 1 Afrimat share for 280 Unicorn shares. Since year-end, the offer has become binding. Astoria, which represents 5% of our assets, Astoria's board is still negotiating with REC in order to acquire its interest in Outdoor Investment Holdings, JB Private Equity, Isaac Carson's, TransX, and Vehicle Care Group in exchange for shares in Astoria. This potential acquisition by Astoria is subject to a number of approvals and is expected to complete in the fourth quarter of this year. Astoria owns 70% of CNA, which was acquired in April 2020. CNA has completed the first 100 trading days under the new management team and is trading at about 60% of comparable previous year levels. It's still early in the life of this investment and a number of risks remain, including the successful establishment of its own technology and logistical systems. The skill with which the management team has navigated the first 3 months bodes well for the future. Then Isaac Carson, which is 3% of assets. During lockdown, ISA maintained its training schedule for all students, and as at the end of July 2020, enrollments for the 21 year are in line with the previous year. The Vehicle Care Group, which is 3% of assets. Post-lockdown, the sluggish second-hand vehicle market has caused the outstanding book to shrink by 20%. VCG has tightened its credit criteria and has not incurred any bad debts throughout the period. The second-hand vehicle market is returning to normality, with vehicle registration departments slowly working their way through the backlog. In Transex, which is 2% of assets, there's been no change in circumstances at Transex since our last communication. So that's a quick update of the various business, and I think I want to move on to the main idea for today, which is questions from shareholders. So we're going to take questions from the floor. There's a Q&A box on your screen, which you can type those questions, and we will deal with them. Jan and I will deal with them as they come in. Hopefully Jan will deal with most of them. We have received some email questions. I'm going to deal with those things first. But just before I get to the questions, there's one housekeeping item. We're expecting load shedding here in Cape Town at 12 o'clock. Normally this building doesn't get load shedding, but if the UPS kicks in at 12 o'clock, we might lose signal. Stay on board. We will reconnect as soon as the UPS kicks in, if that happens. Okay, so I'm going to move on to the first email questions. The first one was from Mr. Alistair Moulton, and he's got quite a few questions around Astoria's acquisition of CNA. So I'm going to deal with them piecemeal. So first of all, how much was paid for CNA, the size of the lease liability, number of stores, square meterage, number of employees? Jan, can you share that with us?
Sure, we'll do that. So I think we've said it quite a few times. We paid R1 for our investment. Well, between ourselves and our partners, we paid R1 for the investment. So we technically paid 70 cents for our investment in CNA. In exchange for that investment, we received about 150 million rand of stock in the stores, and that's at cost excluding VAT. And the bulk of that stock was younger than 6 months, so it is real tradable stock. It's not old stock. We've also taken over ownership of 165 stores, which if we have to roll out a store footprint of 165 stores today will probably cost us in the region of 400 million rand. Just to establish that. We would have to incur deposits or guarantees in the order of 35 or 40 million rand, which we didn't have to do in this transaction. And that's, call it 400 million in assets that we got. The liability on the other side is we had to take over the leases for all of those stores, and we had to take on 1,100 of the employees of CNA. Most of those employees are employed in the store, somewhere between 5 and 7 people per store. There was a slightly bloated head office contingent, which the new management team has dealt with and is in the process of dealing with. Obviously, CNA before was run as a division of Edcon's head office. So we need to establish, or the management team needs to establish, a new head office function that's HR, IT, dealing with leases, a finance department, marketing, etc. So all of that's being put in place at the moment. So I think the crucial thing is that from Astoria's point of view, there was a commitment of only 7 million rand ever to be invested if it's needed in this business. There's no liabilities that come onto our balance sheet. If we have to so the business will have to stand on its own. We haven't given any guarantees from Astoria's point of view. So the maximum that we as part owners of CNA can stand to lose is the 7 million rand that we've committed to the business, nothing more than that. I think that, the square meterage, it's busy changing at the moment. I think the average store is about 220 squares, so you can get a sense of that.
So, and point of sales and distribution, any other CapEx requirements there?
So we need to install a new, as we highlighted before, we need to install our own ERP system. So we need to spend in the order of about 15 million rand to install a new system. At the moment, CNA runs on the IT backbone of Edcon. We've agreed that should be out by the end of September, and then also the logistical platform, which is the warehouses, the guys will be out by the end of August. But those are real risks that remain for the business. If we don't get out of there in time, then there is a risk to the business.
Yeah, but it's safe to say the management team is dealing with these things and is aware of them. These things aren't coming as a surprise.
No. So all of these were obviously established during our due diligence and our negotiations with the previous owners. So there haven't been any surprises there.
Okay. So, and then we have some other questions from Joseph Babarovich relating to Gold Rush, also CNA and Astoria. Let's deal with the CNA questions first. He would like some information on Mr. Benjamin Trisk. For those of you who don't know, he is the CEO of CNA. How old is he? Does he have meaningful skin in the game? Will he be rolling up his sleeves and doing some work? And who are the other key management players of CNA? Mr. Babarovich in brackets says here, you may have stars in our eyes. We may have stars in our eyes about this investment.
Yeah,
Want to comment on that?
we might have stars in our eyes. So Mr. Benjamin Trisk was previously the CEO of Exclusive Books, and he was actually the person that introduced us to the CNA transaction. We've spent, as I say, 2 years in negotiations with him as our partner. Once we bought the business, Benjamin is now the CEO of the business. Ben is writing his own checks, so our agreement with our management teams is that it's not only sweat equity, so for every rand we have to write, he needs to do his proportional share, which he has done so far. Well, Ben is 72. He's one of the most energetic 72-year-olds I've come across in a long time. If you talk to the CNA senior management team, they will tell you that he keeps them busy most of the time. So he's very much involved in the business there. The rest of the team at CNA is Mr. Nazir Patel, who's joined us as the CFO. Nazir used to be the CFO of MTN Group about 6 or 7 years ago. We've been able to convince him out of retirement to join us. And then also on the board of CNA, we have Chris Tugman, who's experienced in IT. He's currently with one of the other large retailers, but he's been invaluable in helping us in that process. So quite a strong team. And then also in the rest of the management team, we have appointed people in marketing and operations, etc. So we're very comfortable with a team there.
Just one thing, does he have a meaningful skin in the game?
Yeah, absolutely. I mean, his family owns 30% of the business, and he's written his check with us for that. And to the extent that any more money is needed in there, he will have to write his check. So he's got meaningful skin in there.
Okay, I think that's dealt with those questions on CNA. Then just on Gold Rush, Mr. Babarovich says the share price is trading at a discount to NAV as reflected in the letter shareholders. The valuation methodology is a key audit matter. He goes on to say the PE ratio for Sun International and Tsogo Sun is below 3. What would the PE ratio be for Gold Rush at the year-end valuation of 7 times EBITDA? Yeah,
look, the PE of Gold Rush is obviously going to be very high. We've never disclosed it, and I don't think we're going to do it at this stage. But I think the answer is that when gaming companies were trading at very high PEs and very high EV/EBITDA multiples, we didn't follow that. In the market, and our valuation, which we've come to at 7 times EV/EBITDA, is our long-term number that we think is the right valuation multiple for Gold Rush. The reason for that is that, compared to some of the other gaming operations, depending on whether you look to Sun or Tsogo, some of them include some hotel assets in there which have different dynamics, different competitive dynamics, and they are all much more asset intensive. If you look at both Sun International and Tsogo, their turnover to asset is probably somewhere in the region of 0.7 times, whereas Gold Rush turnover to assets is over 2. So it's a much more or much less asset intensive business. The other point I would like to make is that while the other gaming companies today are desperately and furiously raising capital just to support their businesses during lockdown and in this period after lockdown, Gold Rush has managed to get through this period without needing capital from any other suppliers, capital suppliers in the business. And it's mainly due to the fact that it has a much smaller capital base. So we think that multiple is appropriate in there. In our valuation method, we don't want to mess around a lot with the estimated earnings number, because I think we can get ourselves into a lot of trouble trying to guess what those normalized numbers are. So the one place where all of that comes together in judgment is in that multiple, and we give you the multiple. So I mean, it's fair for you to be able to adjust that multiple to a number that you think is fair, or you can imply from the share price what the market says, what the multiple. So we're quite comfortable with that number.
Thanks, Jan. And Mr. Babarovich goes on to say or ask, are the valuations used to decide the investment advisory fees, and to whom are these fees paid?
Yes, I think it's fair enough. The RAC pays a fee of 1% of assets to the management company that Piet and Tienus and I own. And obviously those fees are calculated on the value of the portfolio. So that's right, that 7 multiple, whether it's a 6 or an 8 or a 14 or a 3, will have an impact on the value of the fees that get paid to our company. As we wrote in our shareholders letter, the 3 of us now are the single biggest shareholder as a group in RAC, which amounts to quite a number of hundreds of millions of rands. So, the 1% fee compared to our capital investment in the business, frankly, disappears. So the incentive is for us on net asset value per share, not on the level of the fee. Peter?
Yeah, I might add, you can do your own calculation of what 1% management fee is annually. And compare that to some of the remuneration schemes out there, and I think you'll find that our fee is, if anything, we are undervaluing the contribution we bring to this business at that fee. So then he goes on, questions about, Astoria is the next question. It's indicated you will transfer 268 million of value to Astoria and then distribute 90% of the shares received to RACP shareholders, RAC shareholders, and he says not preference shareholders. It is assumed that the preference shareholders will not be recipients of this distribution, and RAC will in due course have as its main investment Gold Rush. Is this correct? How will RAC be paid for this distribution of Astoria shares if preference shareholders are not recipients of the in-specie dividend?
So I think we need to get so technically the ordinary shares of RAC and the preference shares all have the same economic rights. It's just the voting rights that are different. So when we distribute Astoria shares, all RAC shareholders, ordinary and preference shareholders, will receive Astoria shares. So as a preference shareholder today, for every 1 RAC preference share you own, after the distribution, you will own 1 RAC share and 1 Astoria share. Which means that your underlying portfolio is on that moment is still the same, it's just owned in the form of 2 different companies. So RAC won't be rewarded for anything. There's no commissions paid to any of us for achieving this. We're doing this because we think this is in the best long-term interest of us as shareholders of the business, because the Astoria structure is quite attractive to us to pursue our investment proposition going forward. So nothing will change in the value of your investment in that sense.
Okay, and then he asks, who are the managers of Astoria now responsible for the investment in CNA, and who will in due course be responsible for managing the investments of the disparate group of businesses housed in Astoria?
So it will be us. That's just we are we have Astoria has a management agreement already with RAC Advisory in Mauritius, which is a company associated and controlled by us. So it's the same people doing the same stuff going forward. The only difference is that Gold Rush will be the main asset in RAC in South Africa, and most of the other assets will be in Astoria, managed from Mauritius.
Right, thanks, John. I think those are the email questions. Then we have some online questions. I'll deal with them one by one. Again, Mr. Valalam Herzog asks, is Gold Rush profitable operating at 50% of capacity?
So no, the answer is no, Valalam. It's not profitable at 50. The management team has designed Gold Rush to be profitable at 60% of capacity. So we reckon that during August we should be able to hit 60% of capacity in terms of operations, and it turns out that it looks like it's that way. I think the question behind that is, what happens to the valuation and the profitability. The team is quite adamant that we will be able to get to March next year without having increased liabilities or outstanding debt. So we've already started using revenue to pay down, interest that were accrued during the lockdown, leases that, those leases that were not negotiated away, but were accrued. So we've paid away some of those liabilities. So we think we'll get to March next year with, on the balance sheet side of things, the liability number not having increased where it was in March of this year. We'll have to see where it comes in September now. Obviously, I think liabilities would have increased a little bit. We just won't have enough months of trading behind us to catch up. But our statement a bit earlier is, in all the businesses, the teams have decided this is the field of play. We can't hope for a new world in future. We have to manage the businesses for what's in front of us. We have to assume that the effect of the lockdown has meant that the South African economy is going to take some time to recover, and we have to plan for it. There's a broader question we can talk about: who's more vulnerable in the next 3 or 4 years. I think if I was a government employee, I would be very concerned at the moment, because it's clear that government's going to run out of money to pay everybody. Those of us in the private sector and that have learned how to make a plan, I think we set up to be able to survive. But I think if you're a government employee, or if your business is servicing or selling to government employees, I think you should be very careful. But that's a separate point that answers the gold rush question.
I think in terms of gold rush, basically what's happened with COVID and the lockdown is that our business plans have been set back by about a year. We're about a year behind schedule now. The important thing is the business itself has not gone backwards. It's intact, the capitalization is intact, and is ready to go. As the economy picks up, it will pick up as well. So that's on Gold Rush. So no, it's not profitable at 50%. Mr. Justin Ritchie asks, can you explain your thinking on the amount of debt to be left behind in RAC once the RAC Astoria split happens? It strikes us that Gold Rush already has a significant amount of debt. Do you expect to leave more debt at the Holdco RAC level?
Justin, I think that answer will depend on what our bankers are comfortable with. So obviously that's a number that we are still negotiating with ABSA. Our preference is to leave the bulk or the majority of that debt on the RAC side in that Holdco, but it might be that some of the debt will have to go with assets over to Astoria. It might also be that we repay some of the debt and get it to a different level by that time. Understand, the cost there is linked to prime, so interest rates are lower. So the actual debt funding on 250 million rand of debt on the RAC level, we think is quite doable and manageable. I think we have discussed it with some of you before. We had set money aside on the Gold Rush balance sheet in order to pay our first dividend this September. That cash has basically been consumed now in the business being closed and lockdown. So it's obvious we won't be able, and we won't ask management to pay a dividend from Gold Rush in this September. But I'm comfortable that it's been built to generate dividends. And as I think again we've discussed it before, once RAC has its own or the single majority asset being Gold Rush, the idea is that the cash flow that generates from Gold Rush can be used to either pay down debt in Gold Rush, it can be used to pay down debt on a RAC level, it can be used to buy back shares either in Gold Rush or on a RAC level, or it can be used to pay dividend. That's the classical setup for value creation from a listed company. If we could have designed something that suits us the best, that is the design. So we've built it for the last 7 years. So we're going to try and set it up in that way to be able to create the most value for RAC shareholders going that way.
NAV per share growth, that is the mantra.
That's
what we're trying to do.
Right.
And without putting the whole business at risk by taking on too much debt at any part of the business, whether it's operating company level or at holding company level. Yeah. I mean, that's something we're very well aware of, and we can see the fallout around us in the market today from companies that did take on too much debt.
Yeah. So can I just make the point on Gold Rush, because Justin, you allude to the indebtedness of the debt on the Gold Rush balance sheet. Of the debt that we disclosed there's just under 400 million rand of debt that have covenants and are to financial institutions. A big part of that debt on the balance sheet is from having acquired assets and machines for Gold Rush this now 2 years ago. The terms of that the debt is to the extent that if we need to, the supplier will take back the machines and the liabilities go away, and we switch it back to a participation rule, so a rental agreement. So in terms of the point about too much debt on a balance sheet is quite an important thing for us to think about. There is another point, and this is probably a broader question about debt in the overall business, is in the world in future, there's a good chance that we will see higher inflation than what we have all been used to in the last couple of years. And in a world like that, you probably would like some debt in your structure.
We think debt is a good thing. but like all good things, too much of a good thing is also not a great thing. So
Yeah.
we are very careful around that issue. And I think what's happened over the past 6 months with COVID, the lockdown, the constrained economy, and the fact that our business, not one of them has needed outside capital or capital from us to help them keep going, I think is testament to that.
Yeah.
Okay, so let's move on to the next question from Wilhelm Herzog. He says, post the Astoria RAC asset sales, RAC becomes essentially the listing vehicle for Gold Rush. Is it accurate to assume that the 1% management fee on RAC's assets, which will then consist solely of Gold Rush, will remain in place? Jan, would you like to comment on that?
Yeah, I think that's a fair assumption that the management fee will remain in place. I guess, Wilhelm, whether you call it a management fee or salaries, the amount of money that will flow out from RAC to have the company manage that won't change materially.
Yeah, so that'll stay the same.
Yeah, so we can give it a different name, but it's going to be roughly the same amount of money.
Okay, and then from Mrs. Sandili Makakula, he asks, can you please provide details regarding the licensing backlogs relating to the gaming asset Gold Rush?
So the licensing backlog that I'm aware of in Gold Rush is mostly around the rollout of limited payout machines. There's no licensing backlog for our bingo licenses. There's no licensing backlog for sports betting licenses, etc. The various gambling boards, and there we operate in 9 different provinces, have different levels of backlogs. One of the biggest things that the Gold Rush team has focused on is the maintenance and the preservation of our licenses. And we know that preserving your license is quite a fickle administration exercise. So that's why one of the biggest departments in Gold Rush is our compliance department, to make sure, because obviously everybody knows that a gaming license is a very valuable asset, and therefore if we do one small thing wrong, there's a lot of people that would rather like to take over those licenses. So I'm not aware of massive backlogs. The biggest thing is we would love to roll out more limited payout machines in places like Gauteng, the Northern Cape and the Free State. In most of the other places we don't have any administration issues there.
Okay, then Wilhelm goes on to ask, I assume the 10% retention of Astoria shares in terms of the unbundling is for tax purposes. Can you perhaps explain why we're doing that?
Yeah, Wilhelm, I think part of it is also to give our bankers comfort that we have sufficient assets inside of RAC to be able to service that debt in the interim period. And it also helps. So you're right, we can't hold more than 10% for tax purposes, but we can hold less than 10%, and it gives us a bit more flexibility, just in terms of assets if we ever need to, that we don't get into trouble.
Yeah. Right, then Mr. Paul Whitburn asks, he says he also asked this question last year, could you please share with us, with your investors, the IRR, the internal rate of return of all investments made by RAC, both current and past investments. Now, this is something we have looked at since you asked it last year, Paul. I just preface the answer Jan's going to give you just now by saying that our NAV per share has grown by just over 7% per annum since inception, and that is basically the IRR of all of the investments put together. That 7%, of course, is measured at quite a low point in March of this year, but still, that is what we've done. But we have looked at each one individually, and I think Jan can give you a bit more color on that.
So perhaps what I should say is that this hasn't been verified by auditors.
Yeah.
We don't really want to pay that money, so just be aware that this hasn't been done. And this is sort of a question, pick between your children which ones you like most. So we've classified it into good, bad, and ugly. So the ugly ones is quite clear. Early in our life, we had about a 2% investment in Protec Kutule that went to zero. So I mean that was our first donut. And then more recently, we had an investment in Dawn, which at the time was probably about a 5% investment in the fund pick, and that's also gone to zero. So those are for all intents and purposes minus 100% IRRs. Then the group which is round about zero or below the average of what we've done since inception. So
these are the bad ones.
That's bad. So yeah. From ugly you move to bad. The worst there is our investment in JB Private Equity, which underlying is good. Unicorn at the moment, as it stands, the IRR is about minus 10%. Our investment in ISA, which is about 2 years old, is minus 6%. Astoria comes out at the north, roughly. We're not done with that transaction, so I mean, it's as it is at the moment. So all the effort we've gone through in the last period has washed out, if you take into account all the interest we've paid on the debt and so on, at about a zero, but it has given us intangible assets, the opportunity.
I think Astoria is an opportunity which you can't get in the numbers.
Yeah, but as it is, mathematically, that's a zero. Transec, surprisingly, with all the effort we've done, also stands at roughly our money back. It's a zero because there's been many moving parts.
But again, we have not exited. Some of these investments we haven't exited. So to calculate the IRR, the investment that still we think has legs in it, I think it's a bit unfair, but that is where we are at the moment.
Yeah. And that obviously Transec includes our investment in West Coast Resources, which was rolled up, etc. And our investment in the hedge fund is always like -1% since we invested IRR, so that's flat. So those are the bad ones. And then on the good side, we disclosed our investment in KWV, which at the conclusion was a 10% IRR. We had current investment in Gold Rush, as it is at this valuation, is about a 14% internal rate of return. We sold Accelerate, which was the management and logistics business that was sold at a 15% IRR. Outdoor Investment Holdings, as of today, is a 15% internal rate of return. Asset Lending or Vehicle Care Group, very recent, that's at about an 18% internal rate of return, but that's, I wouldn't put anything on that. And then the big one was Fledge, which was bought and sold, and that was a 74% IRR. So as I said, we have to think about the technicalities about disclosing it. I think it's a good idea to have a list of completed investments in our annual report, and the IRRs there for you. But I just want to add to the point that Pete made. I think looking at the combined behavior of the portfolio, I mean, that's our effort. That's what we've done. To try and second guess us on any of the single investments, I think, won't really work that well.
But if you have any special insights on our investments today, Paul, please share them with us, which we should keep and which we shouldn't. We look forward to that information. Then there's an anonymous question. Studies have shown that competition for control gives the best shareholder value. Well, that looks more like a comment than a question to me. Okay, so it goes on. So studies have shown that competition for control gives best shareholder value. Do you think the dual share structure is still appropriate in modern markets? Can I start with that question, and then you can add, because I'm sure you have a lot more to add. I just there's a reason we have a dual share structure. It's not by accident. It is because we want to give our investee companies certainty as to their long-term ownership. And when negotiating transactions with the companies that we eventually take stake in the past, that has been proven to be an advantage for us, because those companies like knowing that we will always be around. When I say we, it's myself, Jan, and Tiennis. The people will always be around because they are dealing with people. They're not dealing with some sort of number crunching spreadsheet. Business is about people, and they want to know who are the people that will be in charge. And that's the guarantee we can give them with our control structure. These control structures are coming for criticism from time to time. And yes, a non-voting share has less value than a voting share. There's no doubt about that. But you can put your own discount or premium on the voting versus non-voting share. That's your choice. We think there is an intangible value to the control structure, which lies in our being able to negotiate good terms with investee companies because of the control structure. And Gold Rush is a case in point. We were not the only person bidding for the business at the time, and we were also not offering the highest price for the business at the time. But they decided to go with us because of the control structure. So I think that gives one that sort of advantage. Jan, would you like to add anything to that?
Look, I think the other point there is that whether we have the control structure in place or not, as an investment entity, we accept that we will trade at a discount to NAV. That discount will be smaller or larger. If you look at the history of investment companies in South Africa, at least, once in a lifetime, twice in a lifetime, you trade at or above NAV. But that's rare, and we agree it should be a rare occurrence for this to happen. So having a control structure, not in terms of increasing your shareholders' value, it can change the discount. What is much more important is the rate at which we compound the underlying net asset value. If we had compounded at 14% a year rather than 7%, the actual share price would have been at a much higher level today than not. So I think, as a shareholder, I would rather criticize the ability to, or question the ability to grow the net asset value than actually, the control structure. It could be that you say, well, the control structure means that bad capital allocators stay in charge of the capital allocation decision, and we've been very open about that. I think that's fair that everybody is aware of the structure. We're not trying to hide that. And I do think that as a shareholder or potential shareholder, you have to take that into account, that structure is there, it will stay there indefinitely. And even Astoria has been set up with a similar idea, and that Pete Tieners and I are on control, and that control won't be able to be taken away.
Okay, so that's been the next question on Mr. Kutsa. He asked, is Goldrush at break-even levels at 50% operating capacity? I think Jan has answered that question. It's not, but we think August is looking good so far. Then Mr. David Eberol, he asked, could you talk about what the deferred tax liabilities in RAC are and how much is attributable to Goldrush? And then he goes on to ask, will this liability be crystallized when the Astoria transaction happens, or will this be a Section 42 asset for share CGT deferral? Those are all very good questions.
Yeah. David, it seems like you know your tax act quite well. So
as one should,
and I think in future should know even better. Yeah. So yes, most of the tax liability, comes from the Goldrush investment, but also some of it is related to OIH and some of the other assets. We will, and we have planned for this. Obviously, we've had lots of time because the Astoria transaction took so long. So we have planned for that in that once the assets have been moved or sold from RAC to Astoria, there will still be crystallized capital losses that remains inside of RAC, which will benefit RAC and its shareholders going forward. So there won't be any cash tax leakage in this transaction in terms of having to pay tax out. So we'll retain the cash in the business, and we've optimized, so no, there won't be any tax leakage in there.
Yeah, and I think a bit of good luck with the bad luck around COVID is we're selling the assets out of RAC into Astoria at current valuations, which in our opinion are fairly low because of the economic environment.
Yeah. So just on it's technically it's not a Section 42 transfer. We don't need to do that because there's only 2 assets with significant tax liabilities, but that's offset against some of the other assets which are in a loss situation. So we don't need to employ Section 42.
Yeah. Right. I think that's been answered then. Mr. Keith McLaughlin asks, touching on OIH, the family pet centre strikes me as a strong offering in a growth market. How competitive is this market domestically? What do you view as this business competitive advantage? How large do you think this business could be grown to before reaching domestic maturity? Some colour here on the next 5 to 10 years would be great. Okay, on next 5 to 10 years, go.
So look, if I just look in my own house, how much time the pets spend in our bed and how much time the kids spend on our bed, then it's quite clear that there's a growth opportunity. What's called the humanization of pets around the world is quite a known phenomenon. So you're right. The idea of the pet center came from looking at the business model of Safari and Outdoor, which in essence is a big box, which is not in a shopping center but is a destination mall where your rent is quite low and you can have a lot of stock and is a destination store. So if you think about the Safari and Outdoor shops, that's the model. It's the same here. So the family pet center, I think it's a 2,000 square meter pet shop. It's got dedicated 2 vets. There's, all the levels and quality of pet products, medicine, food, all the accessories around that. You've got all the animals you want, etc. So it's turned out to be quite a successful business, and the model worked. As we know from all retailers, it's margin and stock turn. As you can think about on the pet center, you don't need to import a lot of the products. Our stock turn is quite high and the margins are fairly competitive. And the third bit about that is that the purchase from our customer's point of view is impulse or emotional driven. Yeah. So it is not price driven. the bit that we talk about, which is missing, is obviously the cremation part, which is being built in the business, which has the same dynamics. But you're right. The economics of a single store is quite good, and where we found in Outdoor Investment Holdings is that we now have 5 safari and outdoor stores. There's not really place to roll out more stores. Whereas we can open 5 pet centers just in Gauteng, and then you can open another 5 in other parts, and so the footprint of the family pet center can reasonably grow for a number of years, and the team now has established what it takes to open the first one and the second one. And obviously, as you grow, the supply chain gets in place, and relationships and pricing relationships and all of that improves. They have had to learn a few things about snakes getting spiders or viruses, and losing some of your lizards and pets eating each other. We've also learned that some people bring back pets that they bought for Christmas and they give it back to you for free, so your stock value, the cost of sales benefits from that. So there's a lot of dynamics there, but it is a lovely business. We think there's lots of growth opportunity. The management team agrees with us, and I think there's been enough work done to establish the business model now. The last bit that's falling into place is previously, and I think every retailer will say this, is your location is important. But it is quite important of where you place these stores. And the current carnage in the retail environment and the property side gives us an opportunity to get some good sites on where we can establish the next ones.
I think if I can add to that, I think the learnings from Safari and Outdoor, the big box, in a nice environment, attractive environment, people to come in and explore the merchandise, is very, in that market, highly competitive, because its competition is all single owner stores, very small, dingy, dodgy type stores. Safari Outdoor came in and just came with a completely different presentation, family orientated, smart, inviting. And if you think about the pet shop business, it's the same. Lots of neighborhood stores, single owner. A lot of them are small and dingy, and I think Family Pet Center is bringing something new to that market. So we think the growth prospects are actually quite attractive.
Yeah, and I think we have to consider online businesses as well. And the Family Pet Center doesn't compete with someone that want to order their dog food online. I mean, that's a very different business. So it is about creating the experience, the destination where the entire family can come on a Saturday morning and spend 5 hours, and there's something for everybody to do. So I think it works.
Where's the newest shop?
So the first one was in Midrand, and the second one was open in Fourways.
So Keith, you can go to Fourways and have a look. I think you'll be pleasantly surprised. Then the next question is from Anonymous. Anonymous says investment companies trading at big discounts is not good. We agree. Yeah. And mostly favors the remaining shareholders when companies buy back their shares, and is prejudicial to those shareholders that need or are forced to sell their assets for other purposes. What are your thoughts on that, and what is your strategy and plans to remedy this situation in RAC? Jan, would you like to kick off that? And I've also got some ideas.
Yes, I think Pete said it straight up front. We agree. It's not a good thing trading at a large discount. I think the main strategy there is to grow the net asset value over time. So if you buy something at 50% of the net NAV, and the NAV grows at a decent clip, then the price will, we believe, grow with that. Our main focus is at growing the net asset value of the business over time. We don't like management teams that are focused on their share price only. The lesson we've learned over the years is those management teams that are enamored with their share price normally lose their eye or their sight from the actual valuation of the underlying business, and you start doing things which you think will improve the share price rather than doing the stuff that will improve the underlying value of the business. So we are very aware as day one investors, and as investors that have been consistently over the last 10 years bought more shares in RAC all the time, we're very much aware that the current share price is much lower than any price any of us have paid in the past. So it's not like we are flippant about that. Part of this, and this is why we're splitting the business into two, is to get Gold Rush as a standalone investment, to be able to use that cash flow to optimize that. If we can buy back shares, it means the net asset value per share increased tremendously, which is to the benefit of other shareholders as well. If your question asks, will we be using the cash of the business to prop up the share price just so that the share price is higher, that's not the reason we'll do it. We will have to consider for every 10 million we have to invest, do we buy more of our own shares, and is that a good investment for us, or do we put it into a next investment? I think that's that remains the basic.
That's always a consideration, and very importantly, unfortunately, we can't control the share price. So, although we agree with you that investment companies trading a big discount to NAV is not good, the only thing we can do about it is to grow our NAV per share at an acceptable rate. And obviously, because our share price is trading at such a big discount, the market is saying what we've done in the past is not acceptable. We recognize that, and we will work hard to improve that. Anything else to add, Jan?
No, I think it's clear. We shouldn't promise things that we don't intend doing, and we're aware of the discount, but we don't have active plans here. And even the unbundling of Astoria, I don't think that's really going to add any value. I suspect that after distribution, if you add the two share prices together, I don't think it's going to be worth more the day after unbundling than the
should
day
be,
before.
But it won't, the market won't.
It's unlikely to happen at this stage, and that's not the reason we're doing it. Yeah. We're doing it because we think the Astoria structure gives us a much better platform to grow after tax returns over the next 10 years.
After tax NAV per share growth. Right, then there's a question here again from Anonymous. Can you tell us more about the strategy and performance of the RECM hedge fund? Well, Jan, you manage that fund, so you can talk about that. So
I can refer you to the RECM website. The fund fact sheet is on there as well, and you can read a bit more there. In essence, what has happened is that, as you can see, the investments inside of REC and going forward in Astoria is more and more private investments rather than small stakes in listed companies.
Private being unlisted.
Unlisted,
yes.
Unlisted. So from time to time, we do find what we think are really compelling investment opportunities on the stock exchange, and most of those find their way into the hedge fund now for various reasons. The hedge fund structure allow us to do shorting, which is not that easy in a company structure. There's some tax benefits in doing it in there. There's dealing with prime brokers. So, the hedge fund as it stands focuses primarily on either listed or investment opportunities that's not big enough to fit into REC on its own as a standalone investment. Currently, we have fairly large short positions that's been there for a long time in listed property. We maintain those positions. We think that on the property side, given what's happening in the economy, there's still more pain to come, and that will reflect in the prices of listed property. We have some credit positions where we have invested in credit instruments and lent money to other businesses, which we can do in the hedge fund. Some of those, as you can see from the fund fact sheet, we've invested in index-linked bonds from African Bank, which we think is one of the better capitalized banks, strangely, after the fallout 7-8 years ago, and we get paid 8% real returns there, which is quite a good return. And then we have a number of positions in small, illiquid, cheap assets, listed assets, yeah, which has always been the domain of where RECM found itself. That's where deep value investing gets expressed. So this hedge fund, in essence, is a deep value, a vehicle that explores a deep value hedge fund. Don't get confused by the fact that it's called a hedge fund. Technically, we need to call it that. We don't see ourselves as hedge fund managers. We see ourselves as common sense investors, but we have a strong value bent, and that's what you'll find in that portfolio.
And I think that leads on to the next question from Mr. Gerard Fick. He asked, have we seen an increase in investment opportunities during the last 4 months? And I think that we have seen it, but the investment opportunities today are predominantly in the listed environment. It's listed small caps that are dirt cheap. REC, for instance, as by way of example, trading at 40% of NAV, is a prime example of a small cap that's exceedingly cheap. And there's lots and lots of them listed in the stock exchange. And the private market, the sellers are probably not as, can I say, short-term orientated or not as market orientated, and they know what their businesses are worth, so they're not selling their businesses on the cheap. There are some opportunities. I mean, the CNA transaction we did during lockdown, but that was effectively a forced sale from a business that was from Edgar's that was basically running into trouble. But on the whole, the sellers of private businesses, unlisted businesses, know what their business are worth, and it's very hard to find bargains due to the economic cycle there. It's bargains today are available on the stock exchange. The valuations of small cap businesses on the stock exchange are way below what you paid for what an informed buyer would pay for a similar business that was unlisted.
Perhaps the one thing to add to that, Gerard, is on the private side, we have had quite a number of calls during lockdown. But those calls were mostly from businesses that were in distress. And our sense is that that's not the opportunities we would like to take at this stage. You know, if the economy stays in trouble for longer, then even very good businesses might need, you know, some help in terms of equity or loans or whatever at some stage. And we will probably rather look at opportunities later down the line where, you know, just the initial bit was the weaker companies that need help. We'll rather try and make investments in the stronger companies with better management later on. That's the only bit I can add to that.
Right, then there's an anonymous question. Sorry, there's Shoaib. He asks, do any of RAC's businesses service international tourists significantly, e.g. safari and outdoor?
No, Shoaib, not really. None of our businesses are focused on international tourists. Safari and Outdoor has a very small division, which is take people on organised hunts and so on. But it's a very small part of the business. Most of our sales are dedicated to South Africans. If you expand it a bit further and say, are we in the tourism and or entertainment industry? Of course, Gold Rush is the entertainment industry and has been affected there by lockdown regulations, but no, we're not affected. IA Seminars, which is a small business that is involved in training CAs in IFRS globally. That business is affected in a big way because their business model is to organize a get-together for 10 people in Geneva or in Vegas or in Dubai, and then in a private environment being trained in the vagaries of IFRS and credit losses, etc. But so that isn't happening at the moment. That business is a complete standstill, but none of the other businesses are impacted in that way.
In fact, Safari and Outdoor is, as we mentioned in the trading update here, is seasonally doing very well. So the fact that the international people aren't hunting in South Africa at the moment hasn't really affected the business at all.
I think into the forest side, you have to assume that most people that go hunting buy their equipment and their apparel where they live. They don't buy it in close to where the opportunity is. So by the time an American hunter or a Russian hunter arrive in South Africa, they have all their kit already, and only if they forgot something will they come into our shops. It's not a big part of our business.
Right, then Mr. Charles Bowles asked, post the sale of assets ex Gold Rush to Astoria, the RAC vehicle will, as I understand it, be managed externally with a Manco fee payable. This seems similar to listed property stocks with external Mancos, which the market does not like. Do you think the Manco structure will affect market valuation? I think we have spoken about that previously. There will be a management fee payable. I will say that the management fee that is payable to the RAC Astoria vehicle is below what we think the services are worth that they're rendered to those businesses. So we think it's a reasonable fee. The market might not like it, but if you do the calculation, the RAND value of that fee is very reasonable. And we think it is a better deal than you get with many, many other operating listed businesses.
I remember we investigate and do research on listed small companies as well, and we compare this to the head office cost of many of these businesses. I think you'll struggle to find a business with a head office cost that's smaller or less than RAC given the current asset size. So we can call it something else, but as I said to Wilhelm's question, the amount of money that will be paid out will probably remain the same. Right, then there's an anonymous question. Will you seek a similar control structure, or is Pref in Astoria or RAC Pref shareholder have a say in this? So in Astoria, Mauritian law makes it difficult to have a Pref and an ordinary share. But in essence, Astoria will have ordinary shares only, but post unbundling, given the size of our shareholding, PTNS and I will be in control of the voting shares anyway. So there won't be a Pref and an Ord, but I think you should think about this as a similar structure than it is And this is one where the ordinary shareholders of RAC make the decision. So no, the preference shareholders don't have a say in this at the moment.
Yeah. And then there's an anonymous question that Pete, recently on a podcast you mentioned a personal view that there's a 20% chance that SA becomes a failed state. What are your current thoughts on hedging RAC as if we see this chance increasing? I'll say we have no thoughts on hedging RAC against that. We think even in a failed state, good businesses still make money. So we will continue to back the business we own, which we think are all good businesses at this point in time. Some of them have a natural hedge against a failing currency and a failing system. So no, we don't think we will hedge RAC at all against this chance, 20% chance. I think in your own personal portfolio, that's something you should take due consideration of. I think I've also been quoted in other podcasts by saying you should not put all your eggs in one basket and you should diversify. So I think that is the onus is on you to diversify your hedge. We are managing RAC with the mandate of investing in good businesses run by good people, good management, and that's what we're doing, and we're finding that opportunity set in South Africa. The fact that there's an 80% chance that South Africa is a successful state, that gives us encouragement.
Perhaps to add to that is, I always teach my kids, if you want to win at a game, you need to know the rules and you need to know how to score. And if you don't like that game, then go and play in a different field. In this game, we need to understand the rules and we need to play by those rules. It might mean that the rules of the game is not the rules you want as an individual or as a family, but it doesn't mean that the rules don't exist. And what we have seen in the behavior and the actions of the management teams of our various companies is that they can adjust to changes in rules. And they've done it quite well over the last while. And that is, for us, and I assume Anonymous is a shareholder here with us, that is probably the biggest hedge we have, is that we have management teams that can adjust the business and can adopt to the rules. That's the only other bit I can add in.
I think maybe I should also say that I still think that there's a 20% chance that South Africa becomes a failed state, but the converse of that is also true. There's an 80% chance that South Africa is successful, and that is something a lot of people aren't saying at this point in time. I think 100% of people are taking 100% of their money offshore, or trying to at least. So another thing that I'm sure Jan speaks to his family about, I do to mine, is if you want to win in a game, you want to play a game which very few other people are playing. And I think today, very few people are playing the South African game. And I think it's a game that's a lot easier to win than going to try to compete to all the private equity guys, venture capitalists in San Francisco, all the investment banks in New York, all the smart money out of London. Going to compete with those guys is a lot harder. So I think our little pool here is getting emptier and emptier. The competition is getting less and less. And I think that creates opportunities. So again, 80% chance of a successful state in South Africa means huge opportunity. Right, moving on. Where are we now?
There's a follow-up question.
Follow-up question. Is the current JSE share price of RAC fair value in your opinion? Asked differently, if you as a company should be required to pay out a shareholder for its shares, would you offer them the NAV or the current share price? I'll answer the first part, I'll leave the second part to you. So is the current JSE share price of RAC fair value in your opinion? The answer is no, it's not. Jan, you can answer the second part.
I wouldn't know why we would be compelled to pay a shareholder for its shares. But no, if we had to pay out a shareholder, then I guess you won't pay the current share.
So let's take that a step further. I think if we were required to pay out, in other words, if we were required to liquidate the business and pay out all shareholders, they would get NAV.
Yeah,
they would get NAV. Yeah, that is the reality, because that's what. And I would say maybe I should. I don't know if our compliance officers will allow me to say this, but I'm going to say it in any case. I would say that the way we value our business, including Gold Rush, is on the conservative side. So we were forced to liquidate the business, sell all our assets today. I guess, and I would preface this with huge uncertainty, and This has not been audited and it has not been approved by our compliance department, but I would guess we'd probably be able to sell our assets for more than we value them at. That's been our track record in the past. Most of the assets we've sold have been sold at valuations above the valuation that we carried it at, and I think that's true today as well. So I think if we were forced to liquidate the business today, shareholders would at least get NAV per share.
Pete, did I hear you say as a shareholder you would expect to get more than...
Yes, as a shareholder, yeah, correct. Right, so I think that's been dealt with. Mr. Alexander Dicey asks, why did it take you so long to exit Conduit, considering the questionable corporate action that has been happening there for the past few years? I'll answer that because it's my fault. I actually stopped. Jan actually wanted to sell Conduit a long time ago, and I stopped them from doing it because I thought what they were doing there made sense until they started getting close to another business which we know about and which we don't like, and that's when I changed my mind, and that's when we started selling Conduit. So it's my fault that we took too long to exit Conduit. We should have done it a long time ago. Yeah, so that's I can only say that the value destruction there hasn't really been value destruction. We paid basically less than we sold it for effectively over time. But we should have made more money by selling it earlier. But these things are always clear in hindsight.
I think you also have to point out that it is a fairly illiquid stock, so to try and sell the kind of block that we wanted to sell is also not that easy. So we managed to do it.
Yeah. Mrs. Mahagula asks, second question: what discount to REC NAV does management believe the share should be trading at, given the shareholding and capital structure at group level? Look, it's not for us to say at what discount it should trade. We actually think it should trade at a premium to NAV.
Yeah, I think there's many ways to do that calculation. Obviously, we would think it should trade at a premium, but as a rational outside investor, most of the time there will be a discount. It shouldn't be 60%. I think the current discount is excessive. You can look, many conglomerates or investment trusts traded somewhere between 15 and 20%. I think that's not an unfair expectation.
It's true to say, though, that many investment trusts have in the past traded at premiums when the market is enamored with the management team. Braid's example, PSG is an example, they all come and trade at big discounts. So that premium discount is a function of whether the market loves you or hates you, and the market the market is very fickle in that sense. So given the business we know that we own, given our valuation of them, we think a premium is probably warranted. But that the actual share price will be determined by the market and the market's level of infatuation or lack of infatuation at any point in time. Dealt with that, right? No. There's another anonymous question. Why did you decide to divest from Conduit? In short, we don't like the strategic direction of the company. I'll just leave it at that. We don't like the strategic direction. And then Shoaib asks, the percentage discount to NAV has increased over recent years. Was unbundling Goldrush as a standalone listed entity not an option that was considered at some point? If this is done, the market will be forced to put a price on it, thereby unlocking shareholder value and increasing liquidity. Jan, you can start. I've got some ideas on that as well, but maybe you can start.
Yeah, look, Shoaib, when we originally invested in Goldrush, one of the options the management team wanted at the time was, and you're right, we did say by August 2018, Goldrush needed to be listable. So we said we will build the business so that by August 2018, we have the option to list the business if we want. I think over time, our colleagues at Goldrush saw what we need to deal with being a listed company, and they have lost their appetite for being listed completely. I think if Goldrush was listed during COVID lockdown, they would not have been as successful in getting through this than they have been, because they could focus all their time and energy just on running the business.
Yeah.
So if anything,
Mergen didn't get any calls from shareholders. No, not one.
So I think there is an option. Whether the market will be forced to value Goldrush higher or different on its own I have no idea. Even if Goldrush had to be listed on its own today, it will still be a small cap, with a fairly concentrated shareholding, etc. So I'm not sure by listing Goldrush on its own benefits the business. It doesn't need capital. It's proven through one of the harshest economic periods in a life, that it doesn't require capital. So if the only reason for listing it is to get a different valuation, again, there's no need for that valuation at this stage. So in essence, by splitting out Goldrush and the other assets separately, as we are going to propose to do in future, will get Goldrush semi-standalone. It will give us the benefit without having Goldrush management having to deal with all the issues around listing, and it will allow us the opportunity to enhance value for all shareholders in Goldrush and therefore shareholders in REC by using the cash flow to buy back shares or pay down debt.
Yeah.
So we actually think the way we're going down, the route we're taking is the optimal outcome. It's better than just spinning off Goldrush on its own. The one thing that scares me is if we had to take the Goldrush team on a 2-month roadshow now to try and drum up support for a separate listing, that would be completely the wrong thing to do.
Yeah, the listed environment is just not attractive, and I think very few companies really want to be listed at this point in time. Right, then Anonymous, how do you think about your unique situation in SA? We have historically low interest rates with historically low multiples. What assets would you be looking at to take advantage of this widening gap? So, if you ask us with our RAC hat on, in other words, the executive directors of this investment company, of which you might be a shareholder, we aren't targeting any assets to take advantage of this sort of gap. We are targeting businesses, good businesses run by good people that we enjoy working with. That's what we're targeting. And we think those management teams that we then back are able to take advantage of whatever gap ends up in front of them, whether it's interest rate versus multiples, and they'll take advantage of the situation. We back the management teams to do that. That's not for us to do. Our job is to identify the businesses and the management teams to run those businesses and let them get on with the job of identifying gaps and exploiting gaps. And I think COVID-19, this experience we've been through over the past 6 months, has proven that all our businesses, each and every one of them, have that management team in place that is able to deal with the curveballs that life and the markets and government and fear throws at them. And then we can sit back and say we're happy. And I think that's exactly where we are today. So it's not something we think about at all. Jan, would you like to add to that?
Yeah, Pete. Look, Charlie says if you tell me where I'm going to die, I won't go there. So I do think you need to mention where we won't go. And I have to speak for Tienes here, but we're not going into mining again. Tienes, we've said that. So no, I think it's right. Look, we've learned in the last 10 years a bit about niche retail and how retailers work and so on. So I think that helps us to understand opportunities there. The broader sense, and I touched on it a bit earlier, is our sense that there's a good chance of higher inflation in the world ahead, which is a different setup from what we've had for 15 or 20 years, and I think one would have to consider that. So all of a sudden, businesses with slightly more debt in the balance sheet, with real assets, etc. Those are things that we.
That sounds like a mining company.
I think we're more aware of when things like that come our way. But yeah, I think your question is about low interest rates and low valuations. Yeah. If one thing, even as deep value investors, we've learned is the valuation on its own isn't enough. The period over which your value unlock does play a role if you want to compound your value over a period of time.
And the people are key. Absolutely. The people are key. So, and the other thing I think I should add to that, the fact that we will avoid mining as fast as possible is true. What we've learned that we like is business to consumer type businesses, retail type businesses. That's where we've done the best in the past. Those sort of businesses have given us the best IRRs over time. And I think that's where we would want to, and that's basically, if you look at the evolution of our portfolio of businesses That's the direction in which we have moved over time, and I think that's a good place to be in, given the environment in South Africa, given the political future we might or might not face. I think that's a good space to be in, and I think that's probably one we would want to concentrate on going forward.
Exactly.
But again, we're not ruling anything out except possibly mining. Right. Does the recent government tobacco ban worry you? Since I've given up smoking, no, not really. Oh, no, it's probably to do with gold rush.
So I think for two things. The one is it worries me from a government behaviour point of view. I think the way that the South African government has behaved during the lockdown has, if you ever had any doubt about the colours of this tiger, you now know what the stripes are. But it's not only in South Africa. Governments around the world have enjoyed the power that came from using, in some instances, quite bogus predictions about, the effect of the virus and the lockdown and the rules. The other thing that concerned me more was the speed with which the government have been able to co-opt what Nassim Taleb calls the useful idiots, the people that keep on snitching with their neighbours for not wearing a mask or going for a walk or taking the dog out to the garden or whatever. So, those are the things that concern me from human behaviour, just because I didn't think that South Africa could be a society like that, and we've proven that we are just normal, and that South African society is like that. When it comes to, if the tobacco ban into gold rush, well, for one thing, what it has taught us is that, it's probably because it was a blanket ban everywhere, but July has shown that gold rush, in essence, we have 50% of our capacity open and we're trading at 50%. So people have found a way to come and enjoy the entertainment the way they wanted. So if anything, I think this has made me more comfortable with the future of gold rush rather than less comfortable, having seen this in action.
Yeah.
But the broader concern is more about, the way in which government behaves, because many of our businesses operate under license, and if you can have arbitrary regulations, we can't write stuff like this on, our SENS announcements. But during lockdown, we've been in court 7 times to allow our various underlying businesses to just do what they're supposed to be able to do. We had to take the Minister of Police and some of the other high ranking officers to court in order for some CNA stores to open, or for Safari and Outdoor to be able to open its business on the right time under regulations. And I think that's one of the other points which feeds into Pete's comment about earlier about slightly larger businesses competing with the smaller ones. I feel very sorry for entrepreneurs that run mom and pop shops, individuals that are caught up in all this regulation at the moment and doesn't have the luxury and the support of a structure like we have here, where when the guys needed to go to court, we could say that's fine, get the best advocate and let's get to the judge so we can carry on. Whereas if you run a restaurant in Bree Street in Cape Town, you don't have that luxury, and your economic future is decimated. So I do think size helps a little bit here. But I think I'm going on a rant here. We are worried about the government's behaviour.
But not only the government, also human behaviour,
Yeah.
The general public's behaviour in terms of encouraging the lockdown, supporting the lockdown, I think was very worrying as well. But in any case, that's another matter. Okay, next question. David Eberall asks, what is your hurdle or ROIC, return on invested capital, on reinvestment of capital in the business versus sending profits to the centre and buying back shares? So, I think our hurdle for returns are maybe over 20%. That's the target we set ourselves. We don't always achieve that, but that is the target we set ourselves. To date, most of our businesses are young, growing businesses, so they have not generated lots of cash that we needed to make that call of, should we take this money and buy back shares or reinvest it or buy something else? We haven't really had the luxury of being in a position to make that call a lot of times. So, but at the end of the day, it is the return we expect on investment that will guide our capital allocation amongst all the different options we have of repaying debt, buying other businesses, buying back shares, whatever. It's the return on capital and the NAV growth per share. That will guide our decisions.
Look, if I can paraphrase what Pete says there, is that young growing businesses in essence are reinvesting their cash in their own operations.
Yes.
So if you think about, Gold Rush can open another bingo hall if they have another license, or, roll out more LPMs. Safari can either open a new store or buy more stock for turnover. The same asset lending could put out more money on their book or vehicle care group, etc. So in essence, these guys always start with, if I have the cash in my bank, what is the opportunity in front of me? And there I have to say Outdoor Investment Holdings is one of those examples where, and we said it in our shareholders letter, there's a business that have had the discipline. When we got involved, it had 2 shops. At the moment, there's 5 shops, but it has said no thank you probably to 15 other opportunities to open another safari and outdoor shop. We cannot open one in Uppington because people hunt in the Kalahari. We have to open the shop where people live. We cannot open a shop in Windhoek because people go to Namibia. So there's been many times where that business said, no, thank you. We won't take that money and open another shop, which is our business, but we can buy more stock, or we're back with the integrate buying Inyati, in some of the supply chain, or opening up a new concept like Family Plat Center, and in the process, they have paid dividend and bought back some of their own shares. So, and that hurdle has been 20 to 25% return on invested capital. The fact that we haven't achieved the blended 20% doesn't mean that's not a hurdle. So we aim high here, and we'd rather not make investments and not pull the trigger than go into something which is just mediocre for the sake of having the money invested.
Okay, then Paul Whitman asked another question. Will there be sufficient assets in Astoria to cover the Mauritian cost structures? Will there essentially be 2 cost structures, one in Mauritius and another for the JSE listing, Gold Rush in other words?
Yeah, look, the actual, outside of the management fee, the other cost structures, as you can see over the years, we've been able to maintain that at very low levels. So I expect, the combined cost structure between the two to perhaps be slightly more, but I don't think, Paul, really don't think it's not going to be significantly more. But it's a good question. I suspect that, we don't want, at a 300 million NAV or a 350, that is not big enough. So our ambition for Astoria is to be bigger. We made that point in our shareholders letter to say that we don't think the current 100 million rand in cash that we have available might not be enough to pursue the investment opportunities. So it might mean that we need to find other ways of raising capital. But, so yeah, I don't think that it's not going to be a cost issue. I think it's more to pursue opportunities.
Right, and David Eberall, he asked again on CNA, it strikes me that the new management team has been involved in books and in stationery. What gives you the confidence CNA can overcome the structural shift to e-commerce in these products? Do you anticipate a change of SKU set, i.e. offering a more differentiated product to the consumer? I think that's a key question about CNA. Thank you.
Yeah. David, you're right. Look, CNA in essence sells paper. If you think about it, paper in various forms, whether it's magazines, books, board games, wrapping paper, etc. So at heart, CNA is a paper seller, but it's a paper retailer, not a wholesaler. And as much as one would think that this is a commodity product, you'd be surprised at the gross margins that CNA, even in its previous form, but in its current form, achieve on something as commoditized as these boxes of printing paper, whether it's Typepack or Mondi, it's Rotatron. So we are confident that the actual margins that CNA can achieve on the chosen lines. So if you go into one of the CNA stores, you'll see we're not involved in technology. We don't sell, cheap laptops or cell phones or Xbox controllers or any of that anymore. CNA in essence is a book and stationery and games and wrapping paper retailer now, which means that we need a bit smaller footprint, which has been happening already. So the previous guys have done the right stuff already. So in the end, to get a retailer right, you need the right turnover at the right margin, and you need to fit your expense base into that. And for a retailer, it's rental and staff salaries and sort of your management infrastructure that you need to get right. We have a blueprint in terms of exactly what those margins should be. It's been designed with the current management team. They know exactly where to fit in. But it is right. So it's quite clear, and this comes down to the rules that you play with and which game you go and play. For CNA to now go and try and compete with Takealot on selling, be an online stationery retailer trying to sell pens and pencils and erasers and all the other stuff and type paper online, there's no way we can compete with take a lot. I mean, the infrastructure is much bigger. Naspers has put another R1 billion into building out that infrastructure. CNA cannot build. I mean, we can download Spotify and set it up over a weekend. So getting the website is actually quite easy. Shopify. So we can get that quite quickly. The infrastructure behind that in terms of delivery and moving the stuff around, and that's what we've learned from some of the other businesses. It's easy to set up a website and everybody wants to have e-commerce. But if you don't have a clear e-commerce strategy, you lose more money. And you lose a lot of money to Facebook and Google, because those are the guys that's making the money from everybody that want to be online, because every single business now want to advertise on Instagram and Facebook and Google AdWords and so on. And that's not the route to success. So CNA is not going to compete with exclusive books. Exclusive books is a top end where the whole proposition is we have a very expensive store where people like to come in, drink coffee, sit around, read their book. But if you look at the stats, not a lot of those visits convert into purchase. On the other hand, you have bargain books, etc., which is a bit like a Safari and Outdoor. It's a destination store where there's lots of product and people go and they mostly buy the back end of the printing run and they make very good money from doing it. CNA, if I look at the whole store base, the shops that make more money and much more profitable are the ones that are not in the big city centers. There's no reason to have a CNA in the Waterfront or in Tiger Valley or in Mainland Shopping Centre if it doesn't make money. CNA is not the business that need a big flagship store where you lose money. So it's all about rent to turnover. Do you get the turnover and the environment? And also, every society can only buy so much stationery and paper and printing and so on. So if P&A or one of the other guys are in a town like Graafrenet already, we're not going to go and open a store there because there's not enough buying power. So it's all rational return on capital decisions. So you're right, we are very clear about what it is that CNA is. And in short, CNA wants to provide for every family in South Africa that have children somewhere between 6 and 14. Because that means that we are focusing on, the school-related education, and that family will also be interested in books and some of the others. But the technology stuff, we're not going to do. There's other people that do it much better. So we're quite clear about what the product line is.
Right. There's a question, another really good one. Why do you need to be a listed entity if you consider the cost of being listed on the JSE and the small trading activity of REC shares? I don't think we need to be a listed entity. The fact is we are one today, and that is where we are. We would have hoped to have less regulations, less red tape, less costs, more trading, but that's not where we are today. And those are not, we can't do anything about that. Those are all things outside of our control. As Jan says, you've got to play the game according to the rules that are laid out in front of you, and those are the rules, and we play the game according to that. And we are listed, and there's nothing we can do about that today. Will we still be listed in 10 years' time? I don't know. Can't say. We might or might not still be listed in 10 years' time. It depends on what happens in future. All we are focused on is growing the NAV per share, and then I think some of these other things will start looking after themselves if we do a proper job of that.
But I think it's fair, at the time when REC was listed 10 years ago, this was a source of capital that allowed us to pursue, what we are doing. And I think we need to be cognizant of that, and that is important. There's some of these investments we wouldn't have been able to make if we didn't have REC in its current form. It might be as of today that we don't need to be listed, but at the time it was beneficial to us.
And I do think that being listed has some advantages as well. I think the fact that we are listed and we have this shareholders meeting, we can speak to our shareholders, is an advantage. We think this communication is key, it's important, and we play an important role for our investee companies as a buffer between them and the market. So I think that's another important aspect of being listed as an investment company. So there is a good side to it as well. It's not all bad, but we'll play the game as the rules develop over time.
So Dimitri says, when I think of stationery, I think of Walton. So what would make go change my mind and go to CNA?
Because I say so.
Dimitri, look, I think the point is that CNA competes with a number of businesses out there. On the top end, there's exclusive books that sells books and the experience. You've got bargain books that sell books at a price-sensitive point. You've got Typo that sells, high-end, expensive, tweeny stationery. And You have P&A, which I arguably think is the biggest competition for CNA, because they sell the whole range. And CNA management need to compete against all of those. Some of the things that will make you change is if you live in Prescott, there's only one CNA, there's no Waltons there. So, then you go to CNA. Waltons, as it is mostly a stationary business that sell, my understanding is 70 to 80% of its sales is B2B. So they sell to businesses, not to the consumer. So their system, their marketing, their client service, all of that is set up in a very different way. It also means that the location of their stores can be very different. But we are aware, they're very strong competition in there. Even the big retailers, Pick n Pay, ShopRite, Woolworths, all of them sell stationery or parts of the CNA product range, and you have to compete with all of those in the right way. So it will be your experience or your friend's experience at CNA that will convince you to go there, and it will be up to you as a consumer to make that choice.
CNA is a retailer, and it's the retail experience that will convince customers to spend their money there. And I think Benjamin and his team is very well aware of that, and I think you will see the development of CNA over the next 12 to 18 months, and the experience will change, we think. Yeah. But it has the one advantage of the brand. We think the CNA brand still stands for something in many people's minds, and I think if Benjamin and his team can get the actual experience to match the brand, I think then you might change from going from Waltons to CNA. Right, is that it? It's the end of the questions.
I think that's it.
So with that, we can say thank you very much. It doesn't look like we're interrupted by the load shedding. Okay, so the last, it's not a question, it's a comment. Anonymous wants to say thank you for answering all these questions so frankly and honestly. Well, thank you for saying that, Anonymous. We really appreciate that, and we appreciate this time with you. Hopefully next year we can get rid of all this lockdown nonsense and social distancing nonsense, and actually have a cup of tea and some cake with you, and ask and answer the questions in person. Thank you very much for attending. Thanks, Jan.
Thanks, Pete.